All right. I think we can get started. Thank you to those of you who have joined. So this webinar is going to be about increasing liquidity for real estate via tokenization. Um, my name is Gabriel. I work for DigiShares here in the United States. We have a great list of panelists and speakers, and everybody will speak individually at first, and then we'll have a fireside chat discussion at the end. So our first speaker is Klaus Skoning, the CEO of DigiShares, and he will be talking about tokenization and blockchain, I guess giving a general introduction for everyone. So Klaus, if you would, yep, activate, perfect.
Yeah.
The floor is yours.
Thank you. I'll try to see if I can figure out how to share. Just a moment. This is the second time today I give this presentation. I'm currently in Dubai at the World Token Summit, and gave a lecture basically earlier today about this topic here. And welcome to everyone on the webinar, and hopefully we can give an interesting few hours speaking about tokenization and liquidity. So I'll really briefly, I'm going to introduce blockchain and tokenization and DigiShares. So I'm not going to spend too much time on it, but dig directly into it. So as we understand the blockchain, we find that there are two innovations or two basic ideas that are important to understand. One is that you cannot double spend on the chain. This is one of the key innovations coming from the Bitcoin white paper 15 years ago. You're not able to spend your digital currency more than once. The blockchain itself will keep track of this. That means also if you have digital tokenized real estate in your wallet, you're not able to sell it more than once, right? So it only exists at one place on the chain in one wallet at any given time. And if you transfer it somewhere else, the chain secures for you that it always remains only in a single copy. And that's, of course, extremely important in order to be able to transact with tokenized real estate and any kind of tokenized security. The second sort of intuition or basic idea of the chain that is important to understand, that it's a global ledger or global Excel sheet. The blockchain itself maintains a massive global consensus about a massive incentive about the contents of the chain. So there's a massive incentive to keep the consensus of the contents of the chain, and there's a massive disincentive to cheat about the content or to introduce faulty or corrupt contents into the chain. And that's sort of the second sort of thing that the chain gives you. It gives you absolute consensus about the contents of this global Excel sheet, a global database on a global basis, right? So you can be absolutely sure that what you have in the wallet is also what everyone else agrees that you have in your wallet. So it's a really secure system that you can transact with globally, and you can use it, of course, for digital currencies, but also now for tokenized real estate. So, of course, you can make, over the years, many applications have been built on top of the chain. One is just simple transfer of digital currencies from one wallet to another, and comparing to the existing system with correspondent banks, of course, it's much more efficient, much less expensive, and much more transparent and trackable. Similar, if you want to compare the ability to trade tokens in a peer-to-peer fashion from wallet to wallet, that's a direct smart contract, a direct operation that happens and takes only a few minutes, whereas the similar transaction on a normal stock exchange can take several days to settle, and involves many different parties, and it's just a complicated transaction to carry out. So it's clear that the blockchain technology is much more efficient and creates new opportunities for doing things more efficiently, including tokenization. So tokenization is, of course, the act of representing ownership of real-world assets as tokens on the chain. So you can transact in a similar way that you can with digital currencies. You can Bitcoin, Ethereum, and so on. You can do the same with now with tokenized real estate. So you can keep it in your wallet, you can transact with it in a peer-to-peer fashion. You can you can transact much more efficiently and with much reduced costs compared to the existing systems. The extreme automation that you can achieve with tokenization allows you also to manage many more investors, maybe tens of thousands of investors as easily as you could manage 10 or 20 investors before. So you can reduce the ticket size and you can open up for retail investors. So instead of requiring 100,000 US as investment or minimum ticket size, you can go down to 100 or 1,000. You can facilitate peer-to-peer trading, which is actually a unique innovation with the blockchain technology. So if you look at existing real estate crowdfunding platforms, they never provide the ability to trade. That requires blockchain technology to be able to do it without counterparty risk. So with a platform like the one provided by DDCS, you can get full control over the tokenization process. You can automate, you can reduce costs, you can increase liquidity, so you can make your assets tradable. At least you can make it possible to make them tradable. So you have the option of trading, and that in itself will, in some cases, increase the value of the underlying more liquid asset. You can open up for retail. You can open up for institutional investors because they prefer to invest into more liquid assets. And you can longer term, once we have made some real estate assets liquid, you can also allow for the ability to use the collateral, the real estate backed tokens as collateral for DeFi loans. We see two major trends converging that will hopefully longer term make it a certainty that tokenization will become very widespread. One is the increasing growth of retail real estate investors. We see the trend already now with REITs. More and more individuals are becoming interested to invest into real estate. They invest into REITs now, but longer term, of course, they will also be able to invest into real estate-backed tokens. The other trend is we see an increasing amount of active wallets on the chain. And these two trends together, of course, enable more and more users, more and more individual investors to invest into real estate-backed tokens. So they can do it technically, and they also know how to do it, and they are also interested in actually doing it. And longer term, of course, it's our belief and understanding that tokenization will become the favored infrastructure of the financial services markets in itself. So it will just become the new infrastructure and the new way of doing things. The tokenization term will fade into the background and will just become the normal way of doing things. Wallets also will become something that everybody will have access to. The banks will offer wallets. The telco operators will offer wallets. You can get a wallet on your iPhone and so on. They'll become so easy to use that everyone will be using them, and you will have national digital currencies, right? So all of that will support the tokenization growth. Also, as we see, it's projected by a lot of the large financial services players that the tokenization industry will grow a lot. Boston Consulting Group estimates it to grow to like 16 trillion by 2030. BlackRock sees it as the next evolution in the financial markets. JP Morgan sees it as traditional finance killer app. So it's definitely quite a hot space to be in, and it looks like it's going to be growing quite fast. Real estate that we are primarily focused on is of course a massive asset class, $326.5 trillion of assets globally. Only around less than 1% of this is liquid in the form of REITs, and it's mostly sort of totally inaccessible for retail investors. Retail investors in general have only invested 5% of their assets into real estate, which is a pity because real estate investors sit on almost half the global wealth. Institutional investors also limit their investments into real estate because it's not liquid. They prefer to invest into liquid assets. So by fractionalizing real estate and making it more liquid with real estate.exchange, which is the topic today, we can make it more attractive and accessible for everyone. Here's a few use cases. I'm not going to spend a lot of time on this, but basically the use cases we see are to use the system for sort of cost reduction and process optimization, managing share cap table, shareholders tokens and so on, and we have a few clients using the system in this way. We also have many clients using the system for fundraising, or basically an STO, a security token offering. Here's a client doing this, a Spanish client using the system as backend, and then having developed a mobile interface as a front end, facilitating investment into high quality Spanish properties in very small amounts, so ticket size down to 100 euros, and paying out dividends also in crypto. The last use case here is from Market-Based Capital, a Texas-based real estate developer, tokenizing a multifamily property on our platform and then listing it on T0, and sort of getting the full benefit from tokenization, both regarding fractionalization, cost reduction, and liquidity. That's my part. I think we will not take questions now. Gabriel, is that right? I guess back to you.
Yeah,
certainly.
Yeah, thank you, Klaus. I mean, for other speakers in the future, you know, we can take a few questions at the end of the individual presentation, if there are any. But yeah, I guess we'll keep most of them for the fireside chat at the end. And yeah, to attendees, please don't hesitate to ask questions in the Q&A section. So again, not in the chat preferably, but in the Q&A section. Great. So yeah, thanks again, Klaus. Now on to the next speaker, Herwig Konings of Security Token Market. He's going to talk about liquidity and how it's created for security tokens and real estate. So Herwig, if you would please just briefly introduce yourself and then go straight to the presentation.
With pleasure. Thanks for having me, Gabriel, Klaus, the DigiShares team. These are always great, packed with information. I always learn something too. Quick background on myself, everybody. Previously founded a company in compliance. We do investor accreditation software, and that basically gave me a good understanding of the rules, specifically in the United States, on how to raise basically money digitally, legally. And during the ICO era, I already saw a lot of issues with that. So when I was asked to advise a company to actually do an ICO for their Series B, I helped them work with their right lawyers, work with the right developers, work with the right team to be able to basically issue a compliant tokenized offering, which was one of the first back in the day at the United States. And since then formed a consulting company, as well as we have a media and a data company that is purely specifically focused on tokenized securities and assets, now RWAs and many other terms coming to play. And so I'm happy to take some time. I believe my topic here for the next 12 minutes or so is about liquidity, and this is what many consider the holy grail for security tokens or for tokenization. The idea that you can actually now create liquidity for real estate is a huge concept, as well as really for many alternative asset classes, for most private markets, and even for public markets. There are many benefits. Specifically, the big bummer that I have to let everybody know is just by tokenizing it, you don't just create liquidity. That's not how it works. In fact, I am definitely no expert, but everybody should know that liquidity naturally comes from supply and demand, and having deep interest and depth behind that liquidity. And so what tokenization does is it eases liquidity, and it makes it more accessible to more potential buyers, which increases your overall pool. As Klaus mentioned, it's super easy to manage thousands and thousands of investors. So now it's no longer a problem. And it's easier to grow interest, to grow access, and to actually manage your liquidity in many different ways. As I like to talk about it, when I talk to my clients, I refer to it as financial services. A platform like DigiShares enables you to have financial services for your equity in many different capacities. The first that actually Klaus also mentioned is this concept of doing a direct transfer. For the first time ever, you as a holding a private company's shares in self-custody, which, this didn't happen until back in the day when you had bearer bonds or bearer certificates where you held your shares as physical sheets of paper. Now you can hold it as a token. I often look at tokenization as getting a digital receipt for your investment or for your, whatever you purchased. And you can now trade that around in a compliant ecosystem, most importantly, so that if I want to actually do a over-the-counter trade directly to somebody in my network, I can just use the platform through DigiShares to actually transfer the token very easily. I know that on the counterparty, they'll have the right, whatever USDC or maybe some other token, whatever it may be that you're transferring, and there's an immediate swap that can happen. That's the beautiful future of what capital markets are going to look like, and that's why there are going to be markets around OTC buyers. So at the end of the day, creating liquidity for your investors by allowing them to peer-to-peer transfer is cool. But to many, it's not answering that solution of liquidity. Like their concept of liquidity is, I need to be able to go and post it somewhere and immediately I'll be able to sell it, right? And so immediately people are jumping from what I think is kind of funny of markets that really had no transfer, right? What I just described to you with a peer-to-peer transfer with a token usually required lawyers to be in the middle, required multiple checks, required a lot of updating of records, could sometimes cost weeks of time and money to get done. And we can do this transfer instantly. So this is already, I think, an amazing transformation of liquidity, but still people, they expect to have more liquidity. So as an issuer, when you are tokenizing, you need to really think about how you're going to build your liquidity base, if you will, or your liquidity stack. In many cases, you could try to find OTC desks, over-the-counter desks. These sometimes could be funds. These are usually need to be regulated companies because we're dealing with securities. But these are people that are willing to buy your token in bulk and may be able to help with potential market making and essentially enable a way to create a floor price or at least demand and constant buy pressure from one side if people are looking to sell if they hold your token. And this requires, creating relationships. This is different for every asset class. I believe real estate is a fantastic use case. And I believe over the next few years, you're going to see a lot of these solutions come to market because real estate has appraisal values. There are built-in floors to the value that what the asset value might be worth, more or less. And so it's much easier for market makers to come in and price that asset and provide potential liquidity for that token. But of course, it changes depending on the different asset classes, treasuries, and other bonds. They have much more liquid markets because of the standardization and typically because of the lower risk associated, the more ratings, the more transparency, the more information. So you have to deal with these different layers that help create that demand, that buyability, if you will, by different parties. Now, of course, naturally, there are different venues where you can go and create this liquidity. So typically what you will do as an issuer, if you're tokenizing, you're going to look for one of these marketplaces, or if you're an investor, you're likely going to start there to try and find basically a place for matching buyers and sellers, right? And the reason we specify BDATS, that stands for Broker Dealer Alternative Trading System. In the UK, it's a multilateral trading facility. In Singapore, it's something else. It's different all around the world, but it's all more or less the same thing, which is, unlike cryptocurrencies and other specific digital assets, we're talking about securities, and securities must follow specific regulation. There's, over 100 different financial jurisdictions. And depending on where you decide to offer these securities, specifically in the United States, you'll typically need to work with what is called an alternative trading system. But most of these marketplaces although they have the licenses to do it, they are mostly, at the end of the day, digital interfaces designed to plug in wallets and access to be able to trade these different tokenized securities and assets. And so there are different ones all around the world. And in fact, our company, Security Token Market, at stm.co, you can go and track all of the different securities that we at least cover from the different marketplaces and see, what is the buy, the high, the low, what trading activity. You'll go to see that many of them don't trade often for many different reasons, but some of them do have activity. And as I mentioned earlier, and I believe most people who you're going to hear from today will agree that this is what's going to be growing and going to be the soon future of liquidity for a lot of these token products. At the end of the day, it's very difficult for marketplaces to build. Most people may not have been, can go far back enough in Bitcoin when, for example, a place like Mt. Gox was the only place that you could buy it, and there was not exactly great liquidity through those early venues either. And it's the same thing that's happening with tokenization. As standardization and clarity and more products come to market, there's more buyers, there's more interest, and these marketplaces can slowly grow their chicken and the egg problem and get through that. And a lot of them are starting to list more quality products, which will bring in more quality investors, which will potentially create a larger pool of interest behind these products. So you're going to see a lot of these venues, if you will, the new stock exchanges of the future, where you'll be able to trade a lot of different products. But people forget that, especially during this time where there isn't a lot of liquidity while it's still being built, that there's another form of liquidity out there called lending, right? You can go ahead and collateralize your position, get cash against your position, and now you have a form of getting access to capital without having to sell your position, and actually taking full advantage of tokenization, because smart contracts enable it easier for you to essentially manage a loan and create a loan, which makes it easier for lenders to come into the space. So I very much so see the future of, instead of lenders, instead of a private bank having to give you a private loan, which can be a very difficult process to say the least, lenders will be able to go in and see, okay, your wallet holds X amount of assets. If you're willing to collateralize these assets, we're willing to give you these rates depending on how much you own. You're willing to lock up. They can programmatically lend against you, and you can have your money instantly. That's very powerful, especially because real estate, bringing it back to that, it traditionally didn't have liquid markets. The rise of REITs grew in popularity because that would be a way to more or less sell into a liquid vehicle. But ultimately, the individual properties and such, they don't have their own marketplaces. And a lot of real estate issuers and developers, the way they get liquidity is by refinancing and by getting loans and basically leveraging their portfolio. And so this is going to be a huge use case for tokenization, that issuers can now promise, again, financial services to their investors, to their token holders through these different methods. And that's not to say that we also have other tools in our toolbox, and there will be continuously new options that grow. In fact, there's DeFi. So you see this concept of automated market makers, which will, depending on the jurisdiction, you can already take advantage of, or depending on, the ones that are trying to catch up, they're going to be housed under licenses, but ultimately you'll be able to leverage, again, automated market makers, which, offer incredible solutions to slippage and to creating liquidity for products. You'll have automated lenders and lending protocols you'll be able to tap into, and again, take advantage of a lot of those features. And even issuer buybacks, I think, is a cool concept where it's much easier for you as the asset owner to go ahead and say, hey, right now I'm going to offer for the next few days this price point. If somebody wants to sell because you don't want to have an active marketplace, or you don't have one up and running, but you want to offer some liquidity, you can offer these buybacks or loans or different things directly to the token holders so that they can take advantage of some liquidity if it doesn't exist. Because again, this is always the big promise of tokenization. So there's lots more coming. I also love the concept of applying benefits and utilities and experiences. So if you get discounts to services, and if you get access to experience and other benefits to sticking by holding on to your token longer or by owning more, there's going to be lots of great concepts that you can play with liquidity that tie into everything. And that's only possible if you tokenize and you leverage a platform like DigiShare. So highly encouraged there. Many of our clients work with Klaus and the team just because they are absolutely leaders and have fantastic technology. And so with that, reach out to us for our consulting at securitytokenadvisors.com. Or if you want that trading market news and information around the market, stm.co. I'm here out of the studio with my background from the Security Token Show. That's our weekly podcast, newscast on YouTube and everywhere else that covers the market every week. So, feel free to reach out to me on social media or anywhere else, and hopefully happy to answer any questions later on. I'll pass it back.
Thank you so much, Herwig. And I should also say that your Tokenize This conference was really fantastic. And actually, I think it's the first conference that after, as a follow-up, provided a summary, 30, 40 page, very clear summary of everything that was discussed. I thought that was really, really great. So for anyone interested in tokenization, be sure to not miss Tokenize This next year.
I'm sure we're going to catch both you and Klaus in Miami. It's going to be in April for the next Tokenize This. We're looking forward to it.
Fantastic. So thanks again, Herwig. For our next presentation, we have Mark Feidelman of Smart Blocks Agency, who's going to talk about the effects of liquidity in the real estate market, from real estate investment trusts to blockchain-based decentralized exchanges. If anybody has questions, you can just ask them in the Q&A section. So Mark, if you would please activate the video and sound, the floor is yours.
All right, I assume everyone can hear me.
Yep.
I am going to jump right into this. And so my name is Mark Feidelman. I run a tokenization agency. So I work with companies like DigiShares and everyone else in tokenizing real estate, specifically other forms like equity, debt, and so on. But for my purposes, I'm getting more and more involved in real estate just because I think that is the killer use case. We're not there yet. Liquidity, as Herwig mentioned, is really important. I think it's the missing link. Once we have this, we're off to the races. And I'm going to explain why I think so and why I think liquidity is key to this particular industry skyrocketing. So I like to do everything simple. So I break everything down into like pizza analogies. I love pizza. Who doesn't love pizza for that matter, unless you're like need to be gluten-free. Now they have gluten-free pizza. Anyway, so I need you guys to understand what tokenized real estate is. I'm sure most of you do, but this sets up an analogy for the rest of my presentation. So I like to say, think of a real estate project as the pizza, and think of the shares that are being tokenized as slices of pizza. Now, this is a huge pizza with a lot of slices, but you'll be able to follow the analogy. So this magic pizza, this pizza's magic. You can collateralize these pizza slices. You can sell these pizza slices, and you'll be able to transform them all around the world. Okay, so setting that up. So tokenized real estate, simply a pizza where you're fractionalizing or you're slicing up this pizza or this real estate into shares, and then the magic starts. However, the current state of liquidity in tokenized real estate needs definite improvement. So I see it as four major challenges, or actually three big ones, one opportunity. This should be an $18 trillion market by 2032. What I mean by 18 trillion is that's the amount of real estate should be tokenized. Globally, There's somewhere around 350 trillion, depending on who you talk to, global real estate value, 350 trillion. So we're talking about $1 trillion industry here, not $1 billion industry, trillions and hundreds of trillions at that. But three major problems. Number one, the patchwork architecture. Nothing talks to one another. When you see platforms that are out there, they're not really talking to one another. So my slice of pizza can't be traded with somebody else's somewhere else on another platform or other place in the world, just on that particular marketplace for now. That's going to change, but that's a big problem, is you don't have this international global system that talks to one another. There's also the buy side dilemma. Because of the lack of liquidity, we're not seeing a lot of buy side yet. We need that network effect, and this comes from people or systems that are standardized and systematized to work with one another. It also comes from more and more liquidity. And then the third one is lock-in. When you buy these assets on a platform, you're kind of stuck on that platform. There are ways of getting it off, but it's not easy. You know, if it's an Ethereum-based token, yes, you can go and trade it somewhere else, but it's not easy flipping them around. It's not as easy as crypto. But we're going to get there, and I'm going to tell you how. Okay, so why is this important? Liquidity is crucial for any aspect of any financial market, and its importance is magnified in the context of tokenized real estate. Why? Because the ability to quickly buy or sell assets at prices reflective of their current value is a defining characteristic of a liquid market. In traditional real estate investing, liquidity has always been a challenge due to the nature of the assets involved. We'll talk about REITs in a second. That's the exception. However, tokenization introduces a new dynamic to an old traditional market, massive market, that if we can solve, is going to blow the doors off anything you've ever seen in any financial market, including crypto, by far crypto. Okay? So this is the reason why we need liquidity. So how do we do it? All right. As always, I like to break everything down into pizza. So the challenges of liquidity broken down in pizza based on what we just talked about. Fragmented ownership. So people are interested in pizza, but they're hesitant to buy tokens because they're not sure they'll be able to trade them. Moreover, imagine tokenization of real estate now as a pizza parlor that only has an app that you can buy pizza in that particular, using that app in that particular location. So Domino's Pizza is big here in the US. Imagine that a Domino's Pizza had a Domino's app for only buying pizza in that location, not anywhere in the world or anywhere in the country that you travel. Crazy. Secondly, imagine, this is Magic Pizza. Imagine if the same pizza parlor chains use different apps that were not compatible with one another, or other chains like Pizza Hut here. And yes, they're not today either, but that's the situation that we're in. We should change it. A real estate token should be able to be transferred and sold anywhere. And then we have insufficient buy-side volume. You know, the pizza parlors can churn out tokens. They can churn out pizzas, but you still need those buyers, and they're not getting enough demand because there's not enough liquidity that's out there. And then, of course, you have the lock-in and the lack of marketability. If the pizza or the tokens that buy the pizza lock you into getting slices from a specific parlor, you might be less inclined to invest in them, because maybe I don't want Domino's today. Maybe I want Pizza Hut, or maybe I want a gourmet pizza. Why am I just locked into one? So these are the challenges of liquidity as told with pizza. Okay, so let's look at the liquidity chart. You see every single real estate investment type has low liquidity. They still function. There's still a huge market for it, except for public REITs. What are the problem with public REITs? Well, you don't own the real estate. You own a stock in a portfolio of real estate handled by middlemen. The middlemen are making most of the money. You could make a good return depending on which REIT that you find. I hope you're not in commercial office REITs right now, but that is the only exception to the rule. But there's downsides to owning public REITs. So what we need to do in order to change all that is to move tokenized real estate up into the upper right-hand corner, which is easy to get into and a lot of liquidity. Once we do that, then we get to our 18 trillion by 2032. But how do we do that? The big question, how? So I've got 4 strategies. The first one is we create a centralized or interoperable trading standards where all tokenized real estate assets can be traded on any exchange. You start to see this with Ethereum, but not everyone's using Ethereum. Not everyone's beholden to the same standards. Not everyone allows tokens from different platforms. I think no one does, to be traded on their platform. But this is the first step, I think, in increasing liquidity. You see it in the traditional financial markets, but you're not seeing it in tokenization yet. We're still early, but I haven't even heard discussions about standardization of these things across different exchanges, across different platforms. So that's number one. Number two, we need to create like crypto. I've got a crypto background. We need to introduce market makers and provide liquidity pools. And liquidity pools are simply pools of liquidity from people that have staked their real estate tokens in these marketplaces, or in these, well, it's like Circle for crypto, but you might not be aware of that. But it's just a pool of money that's being used to place buy side and sell side orders, so that every time you go to sell your real estate token, there's a buyer there. And that provides liquidity, that provides a current price, and that provides a way for us to bring a whole lot of more liquidity into the market. Now, why would somebody stake their real estate tokens? Well, somebody's got to pay them rewards or additional earning potential. So imagine you had a real estate token that you can stake, and not only do you get the rental income from the real estate and the potential return when the project is sold, but you get daily interest from an entity. So somebody can make a lot of money doing this, daily entity that pays you to keep your tokens and your liquidity in these liquidity pools. That is strategy number two. It's been proven in crypto that it works, and it can work for us as well. Strategy number three, where's all the liquidity now? Well, they're in the traditional markets, aren't they? I mean, we know the stock markets all around the world have a lot of liquidity. There's other financial markets where there's liquidity. So how do we tie into those? How do we make it easy to work within them? How do we get trading on their platforms? How do we get the liquidity from their platforms onto ours? These are the things, these technological bridges that we need to create in order to make this happen. That will increase liquidity by tapping into somebody else's liquidity. And again, I think after that as well, we're off to the races. Any one of these, I think you need 2 out of the 4 in order to make this go. But you know, I'm saying let's do all 4. All right, of course, you need a secondary market. It's one thing to be able to tokenize your property or your portfolio on a platform. It's another to sell it. You know, we see Uniswap and PancakeSwap in crypto, where anyone can list the token there and have it sold back and forth. Those are secondary markets that provide liquidity, but also they give people confidence that, hey, if I buy in this, I can sell out and I'm not going to have any problem with it. But you need a secondary market for that, and very few platforms have secondary markets, if any. I think there's 1 or 2, and I'm not going to get into who it is, but none of them have come out as, you know, I'm talking about real estate tokenization, has come out as this heavy liquidity, easy to use secondary market. There's another huge opportunity in that. Now they're coming, but we all need to support that. We all need to get behind it, no matter what, who's doing it. So I'm going to break it back down into pizza. Here's how, if we were running a pizza parlor, we explain this with pizza, in case I wasn't clear on what it was. So for strategy number 1, develop a universal standard. Imagine a centralized ordering system in any pizza parlor where customers can order any type of pizza and have it available anywhere in the world and delivered anywhere in the world. That's what we're talking about when we're talking about developing universal token standards. It should work anywhere, and it should be transferable, and there shouldn't be any issue. It should be very fluid. So strategy number 2, establish market makers and liquidity pools, right? So think of these market makers as chefs that are always ready to cook up pizzas to buy or sell, to ensure no customer waits too long and no pizza goes unsold. But liquidity pools are always ready to buy that pizza. So there's never an issue with a buy side or sell side transaction. You knowing that going into a market, you're going to be able to buy and sell your real estate tokens. You're more likely to buy the real estate token in the first place. Strategy number 3, integration with existing financial markets. We need to make sure all these pizzas meet the health standards. All these tokens meet the health standards. It can be ordered offline, online, offline being traditional markets, online being from, our digital marketplaces. All that needs to be in place in order for this thing really to take off. And then finally, the secondary markets and trading platforms. Pizza analogy, setting up special counters in the parlor where customers can easily trade slices of pizza with one another. I know this is fantasy. Nobody's going to do that in a pizza parlor, but this is magic pizza. And I need to be able to convey to you what needs to happen in order for this liquidity problem to be solved. Hopefully I did that. I want to touch on regulations. Global regulations are critical to liquidity. You need to be able to feel confident that you can invest in these things. You can trade in secondary markets. And with DeFi, as Herwig mentioned, you need to be able to feel confident that you're not going to get in trouble for doing these types of things. And why DeFi? I haven't mentioned this before. I'll mention it now. Wasn't planning to. But in the future, you'll be able to take, whether you're a real estate owner or a real estate investor, take those tokens and use them as collateral to borrow against them. So how cool is that? You as a real estate developer or owner don't sell out your project, but then you can take the tokens that didn't sell and you can stake them or collateralize them in DeFi markets. So now you get your income anyway, or the money you need anyway. How cool is that? How much value would we provide to these people if we're able to offer them that? And that is coming. Okay, so my view of regulation of tokenization around the world, my personal view. So take it for what it is. And I've been to every one of these places, okay? And studied them. United Arab Emirates is far, in my opinion, far and above better than anyone else. Especially if you look at VARA, the Virtual Assets Regulatory Authority. They're ahead of the DIFC. I know I'm throwing out acronyms you don't know, but trust me, United Arab Emirates is the best place for regulation right now. Then there's a tie between Asia and Europe. Each are working on things. MiCA is a good start in Europe. Asia's got good security token laws. There's various issues with both Europe and Asia. Europe's a little too specific, a little too narrow. But my gosh, United States, forget about it. I mean, I'm starting a tokenization platform in the United Arab Emirates. I won't even touch the United States for now. I don't want a Wells notice. They're relying on laws from 1940 in order to tell you what you can and can't do. No thanks. I'm not going to take that risk, especially what I've seen with Ripple and some of the other places. So anyway, let's keep moving on. Again, my opinion. You can argue with me on this if you want in the comments. Okay, so my predictions. If these things come to fruition, this is going to be a $12 trillion opportunity by 2030. No questions. Because if you got the liquidity, you've democratized real estate for anyone to invest in. It's harder than ever to invest in real estate if you're younger. I had a hard problem in my generation, but when you talk about the generation now, they have an incredibly difficult time buying into real estate. Fractionalization democratizes it for them, makes it easy for them to get in, especially when it's paying dividends. It's the best opportunity for them, bar none. In my opinion, crypto's way too risky. I advise anyone to get out of that, except for maybe the top 10. Another thing that you're going to see a trend, I think, is sustainable and smart real estate tokens. These are tokens. They're not in place now. Most people aren't thinking about it. That have built-in title insurance, that pay taxes automatically. Governments will be happy about that. That will benefit sustainability, if that's important to you, because it's self-reporting and it's reporting on things that are happening in real time, so we can gather that information up and see it. If everything's on the blockchain, everything's transparent. Okay, so in conclusion, and hopefully I haven't gone over my time here, I like to leave you with four things. The advantages of secondary trading for real estate tokens cannot be understated. We need to make sure those markets work and that they work interoperable. They need to be interoperable so that you can trade from one platform or one exchange to another. Regulations are needed. Dubai, with United Arab Emirates, has started. They did a great job. I give them 4 out of 5 stars, but there's a lot more they can do. Europe and Asia, not far behind. US, joke. You can still do it in the US, but you're taking a risk because there's not a lot, it's not clear. The technology standard, if we can get standards within this industry, liquidity goes up 10x because everyone's going to feel comfortable that no matter where they're buying their real estate tokens, there is a market for it somewhere. And we do need market makers and liquidity pools. This has happened in traditional markets, still happens in traditional markets. It's happened in crypto, and it needs to happen with us. Those are the 4 things that will drive liquidity, and we'll be a $12 trillion industry by 2030 if we do all those things. How do you reach me? Here's my social media, smartblocks.agency, my tokenization agency, with Twitter, LinkedIn. You can also scan this QR code in the lower right-hand corner. I have a Substack newsletter that with 2,800 subscribers, so you can see what I see every single week. I'm in the market. I'm personally doing the research. I'm the one putting this out. Or you can call me at the phone number below it as a US number. So with that, if we're taking questions, I can answer any either now or later.
Thank you, Mark. I think we'll do the questions during the fireside chat. Definitely think some people would disagree with your assessment on the US. I mean, while for sure, you know, when it comes to cryptocurrencies and the attitude of the SEC, you know, I see what you mean, but I think in the realm of tokenized securities, there may be a bit more clarity, but that would be an interesting debate to have during the fireside chat. So everybody, be sure to stick around with us, and we will have that debate. Thanks again, Mark. All right, our next speaker, Richard Johnson, CEO of Texture Capital. What role does the broker-dealer alternative trading system play in providing liquidity optionality? So this is a US-specific regulatory license, and Richard will tell us all about it. And yeah, Richard, if you want to turn on your camera and sound and introduce yourself and go ahead with the presentation, the floor is yours.
Hey, hey, Gabriel. I'm having a bit of issues with the video. If you can enable that for me.
I think now we can see your screen. Yeah.
All right, now there we go. Okay, let me go. Thanks so much. Thanks so much for having me. Let me get this in full screen. Great. So I mean, that was a great presentation we just listened to. I don't know about you though, all that talk about pizza is making me hungry, especially at lunchtime. So apologize if my stomach is rumbling here. It's great to be here on this webinar with you guys at DigiShares. A little bit about Texture Capital. Yeah, I'm the founder and CEO of Texture Capital. We're a digital securities broker-dealer. We help customers tokenize securities, whether it's real estate, equities, fixed income, or any other kind of investment contract. And we have an ATS, alternative trading system, for secondary trading, which is what we're going to be talking about. We are registered with FINRA and the SEC, so we're licensed here in the US to conduct digital securities activities. And you may have seen that we recently announced a partnership with DigiShares, where we're working to integrate Texture Capital's ATS technology as kind of the back end for real estate.exchange. The integration is ongoing, and we're hoping to launch in Q1 of next year. So something for everyone to look forward to there. I know we've got kind of a global audience here and a diverse audience. Maybe people aren't as familiar with what exactly an alternative trading system is. So I thought I would go into that. Basically, there are two ways that the regulators allow you to trade securities electronically in the US. One is either you got to be a national stock exchange, And number two is you need to be an alternative trading system. That's basically it. They're both regulated under the Exchange Act, which was passed in 1934, I believe. And this is actually FINRA's definition of an ATS. It's an SEC-regulated trading venue in which a computerized system matches buy and sell orders of securities. ATSs are relatively new, so new in 1934 anyway. Reg ATS came into force in 1988. And there's an interesting backstory about how that came to be. I got a little screenshot at the bottom right-hand corner here. There's a paper came out in 1995 asking the question, why NASDAQ market makers avoid odd eighth quotes. So for those of you who don't know the history of US capital markets, all shares, instead of being quoted in decimals, used to be quoted in eighths. So you could, instead of trading something at $50.25, it'd be quoted as 50 and a quarter. And they were divided into eight, so there are actually only 8 price points for every dollar. So it was much wider spreads. But what these researchers noticed was that, wait a minute, all the market makers are quoting either a quarter to a half, or a half to 3/4, for example, as the spread, and avoiding the odd eighth quotes. And they did some research in this, and the conclusion was that basically there was collusion among the NASDAQ market makers back then. And there weren't any ATSs, there certainly wasn't a formulated a regime around that. And market makers were the main way you would trade stocks, certainly NASDAQ stocks back then. So the SEC said, well, that's no good. We need to fix this. Let's bring in more competition to fix the problem. So that's kind of what was one of the major catalysts for Reg ATS, which came into force in 1998. And as I said, it prescribes rules for how broker-dealers, specifically broker-dealers, can operate electronic matching systems. There are actually 71 ATSs registered with the SEC. I looked that up last night. I was kind of surprised because I remember a few years ago it was only 40. And according to FINRA, about 9 of those are authorized for crypto asset securities or digital securities, one of whom being Texture Capital. So my background, by the way, is I've been in capital markets for over 20 years. I've been working with ATSs since then. My co-founders have also been in the space. We've got a lot of experience with market structure. My CTO, in fact, is a named inventor on several patents for ATSs that have executed billions of dollars of shares. And we're all attracted to this space because we just saw some tremendous potential opportunities of using the blockchain in capital markets to improve market structure. First, I'm going to go through these in no particular order here, but when you have a digital ledger, you've got a complete record of securities ownership and transaction history. As it's decentralized, many different players, whether it's different broker dealers, different banks, clearinghouses, and so forth, are able to access that same source of truth. So there's tremendous benefits here from having this kind of decentralized shared ledger. And when you compare it to traditional capital markets, there's lots of centralized databases and different things and different types of databases and so forth that people are looking at, and there's a lot of reconciliation going on. Potentially all of these problems are going to be solved with blockchain and digital securities. As I said, complete record of securities ownership is kind of a new way of cap table management. So it's much more streamlined. It's on chain there. We've got increased transparency. We can apply smart contracts, so we can programmatically enforce compliance rules. For example, under Reg D, Regulation D, which is a type of securities exemption here in the US, you have to hold a security for a year before you're able to resell it on the secondary market. Now, sometimes, when there wasn't, before blockchain, the record of securities ownership was typically a PDF document or something. Maybe it's in a lawyer's drawer or somewhere like that. And now we're able to kind of, a smart contract is able to like check the blockchain. It can see when that investor received the shares. It can check, did they hold them for more than a year? If so, yes, and that is a good trade that we can accept that order. Another example of enforced compliance, I think this is a key feature here. There's other rules depending on the type of company you have. You may have a maximum number of shareholders of 2,000 shareholders. again, that is something that you can kind of check very easily by looking at the smart contract of the security token and seeing if you're complying with that. And if you're going to go over that, again, we can prevent a trade in that example there. I'm going to talk about liquidity. That's a big factor. What we want to do is kind of leverage this technology, the single source of truth. There's also like lower frictions in securities servicing. What I'm talking about there is having dividend payments on chain, and things like that. And combining all these things together, there's a tremendous potential to reduce the illiquidity discount by taking some of these private assets, making them more liquid. There's a blog on our website looking at the liquidity discount. In fact, there's a whole body of research on basically the discount that people will have to sell their securities at if there's a lack of liquidity, and the estimates range from 10% to 44% discounts. So if we can close that a little bit, that delivers meaningful value to market participants overall. So highlighting here, what does an ATS do, basically? So on the left-hand side, I've got the traditional ATS, which is, as I said, there's something like 60 or so of them in the market right now. All the investors need to be onboarded. You do KYC, you do AML on every single investor out there. That's a cornerstone of US securities regulations. Assets are enabled for trading or listed on them. Sometimes people say listing is just an exchange word, but let's go with it anyway. Assets are enabled for trading. You can accept different order types. There are limit orders, market orders. In the public equity space in the US, there's a whole plethora of other very complex order types, with funny names like slide not hide, and all these different types of order behaviors. We haven't got there yet in the digital security space, but we were able to kind of learn from some of these examples in digital markets, and potentially implement them as necessary going forward. Data display and dissemination, order matching, different ways to match orders. One of the rules that we have to comply with is that the order matching needs to be deterministic, meaning there needs to be rules, and we have an ATS user manual that we publish. We show you the rules that our ATS uses to execute orders. There are different types. You can have an auction, which is where maybe it's a blind auction. Everyone puts their orders in. You find the best price that clears the auction book. You can have a traditional lit order book, which is what you'll probably see if you go to Coinbase or the New York Stock Exchange. There are dark pools, which is there's no information, but you're sending the order in. So the advantage there is that you're not signaling the market. Like if you had a large order to sell in a security that wasn't particularly liquid, and you put it onto a lit order book, all the other market participants could see that and they'd move the market down. So you would be disadvantaged. So often if you want to sell a large block of stock, you'll use a dark pool or something like that. And then there's also another type of matching called negotiated matching, which is basically where an ATS brings together buyers and sellers who are able to kind of negotiate through chat functionality and execute their trade. So lots of different ways of doing things there, which we're looking to apply in the digital security space. And of course, trade reporting. You've got to report trades to the regulators and to other market participants. Digital ATS has all of that, most of that anyway, but also we've got to add on all the blockchain side of things. So we need to integrate with different blockchains. From our point of view at Texture, it can be public. It can be permissioned subnets like we're seeing on Avalanche or Ethereum, or it can be fully permissioned like the Canton network or R3 or some of these other places. We as a firm are agnostic to that. There's a specific type of smart contract that you want to look for, a security token smart contract. So a couple of most common ones are ERC 1400 or 1404, and then ERC 3643. They're the Ethereum standards there. And they have specific rules. You need to be able to prevent securities being transferred to a non-whitelisted wallet. So that again make sure that everyone who receives securities in a transaction has been through a KYC process. You also need to be able to, if there is a hacking event or something and they're stolen, you have to rely on the transfer agent's books and records, and you can burn the stolen tokens and reissue new tokens to the investors. Some of the different rules that are in these security token smart contracts. We also need to have integrations with transfer agents, very, very key part of the digital ATS world. And in liquidity, there always needs to be a transfer agent involved. In certain circumstances, the issuer themselves can be their own transfer agent, but it's a key part of the market structure and the rules. And certainly the way our ATS works is we always make sure that the blockchain record is kept in sync. We're monitoring to make sure it's kept in sync with the transfer agent records. And of course, DigiShares, as you may know, is a transfer agent here in the US. So that's a great service they're adding to their customers. We need to have custody integrations. Most ATSs, most digital ATSs are not able to take custody of securities. So sometimes somebody talked about self-custody. That is an option as long as you have the transfer agent in place as well. And there are other kind of qualified custodians that can be utilized. And settlement coordination is another role that we play. We need, once a trade happens, as a broker-dealer and ATS that doesn't have custody, we're not doing the custody as well, or the settlement as well, but we need to make sure that the transfer agent is moving the shares from the seller to the buyer, and that the cash is getting moved from the buyer to the seller. We're not affecting those movements, but we need to make sure that they're happening. I want to talk about DEXs a little bit. There's a lot of talk about decentralized exchanges in the obviously in the crypto space and how they may apply to the security token space. Well, here's some differences. First of all, the alternative trading system is SEC regulated. Most, if not all, decentralized exchanges are not SEC regulated. So that means they cannot trade security tokens or securities. There is in fact a proposal from the SEC where they're trying to redefine the definition of the word exchange and bring all decentralized exchanges under the Exchange Act, either as an ATS or as an exchange. I don't think it's going to go through, but that could certainly have big implications mainly for the DeFi world, not so much for the regulated folks like ourselves here. In an ATS, all investors are KYC'd and screened for AML. Sometimes that happens on DEXs, not necessarily. I'd say one kind of advantage perhaps that the decentralized exchanges have right now over the digital ATSs is that they're utilizing automated market makers. In the space I am with the regulated security tokens, market making is just beginning to start happening. What we really want to do is get more assets on these platforms like Textures first, and then the market makers will come in. So that's kind of still a work in progress. We have traditional corporate structure. We're a company that's regulated. We're not decentralized, we're centralized. In our case, we're a Delaware corporation like many others. Whereas DEXs use native token economics. Another one of the issues here around potentially using DEXs to trade securities, that sometimes that native token may be viewed as a security token, which makes the trading of it difficult in an ATS context. So that's another consideration. And then finally, there's risk of hacking in any kind of DeFi protocols. We see stories about this. I know that the smart contract can get compromised. There is, which is a risk. We read stories about people losing their money and their crypto and whatever in the DeFi space all the time. There's much less risk of that in the regulated space because, as I said, we rely on a smart contract, on a transfer agent to maintain the official records of ownership, and we also work with separated custodians and transfer agents as well. So there's lower risk, smart contract risk here. I don't know how I'm doing on time. Hopefully not running over. I'll be wrapping up very quickly here. So one of the biggest themes that everyone's been hearing right now, I think, is probably the tokenization of real world assets. We actually did a study on it recently. I know some folks have been quoting the Citi numbers and the World Economic Forum, 4 trillion to 10 trillion being tokenized by 2030. We did our own survey. You can access it on our website. The link is there. We looked at what are the preferred real world assets people want to see on chain. Number one was real estate, which is what we're talking about today. And then we see some of the others, alternative assets such as fine art, music royalties, private company shares, PE funds, private credit, and so on down the list. In fact, if you look at that list, nearly all of them are securities. The only one that isn't is commodities, essentially. But every other one of these is a security. So when people talk about putting real world assets on chain, most of the time that's going to be a security, and most of the time it's going to need to trade through a regulated ATS like Textures. That is it. Looking forward to joining in the fireside chat at the end. Here's my contact information if you need to get hold of me. Thanks very much, Gabriel, and the DigiShares team.
Thank you, Richard. And yeah, it's been a pleasure working with Texture throughout the months and years, and you guys have built a great platform. So yeah, we will move forward with the next speaker, Kristaps Kuders, CEO and real estate developer at coreestate.io. So he'll be talking about a real estate developer use case. So going through the first tokenized real estate, tokenization of real estate in Scandinavia, the first one. And if you have any questions, yeah, please ask them in the Q&A section. Kristaps, if you could activate the camera and sound.
Yeah, I'm here.
Yep, the floor is yours.
Hi, Gabriel.
Hey.
Hey, and thank you, everyone. I'm gonna start sharing my screen as well. Well, good evening from Europe, and good morning or good day, wherever you are in the world. And thank you for inviting me. I think you can see my screen right now.
Yes, we can.
Yes, you can. Good. Yes, I'm actually very great to see how this space has been involved since I spoke last time at the DigiShares seminar. It was almost a year ago. So I still remember mostly we spoke about what is tokenization and why it's good and such things. And now I can see how it has evolved to, we speak about things like liquidity, secondary markets, and more developed things. So this space has already grown a lot. And that's actually really good to see. And I'm looking forward what it's about, what we're going to speak in 2 years from now, right? Just to say about that, my name is Kristaps Kuders. I am a CEO and co-founder of CoreEstate. We are in Denmark-based real estate developer company as a startup as well, since we also like to call ourselves as a tech company, actually, and which does develop real estate. CoreEstate's mission, essentially, or vision, was to build sustainable housing worldwide, and that includes that we would like these houses is actually affordable and accessible for everyone, meaning that everyone can actually buy it and live in it, or like, not buying the whole house, just buy a little fraction, because essentially as a humans, we kind of only care about things we own. It doesn't really matter, do we own 100%, then we care a lot. But if you just own, 1% or less than 1%, or just, a very small fraction, we still care about it. And that's something, because we have a team of architects and engineers, and they work for years on some housing, and then you treat this house like without any feeling, it's lost in the way of your development. So we had this vision, and we wanted to simply build high quality housing, not charge crazy rent, so people can actually live in it. And also that, it's not owned by a bank or somebody else, or just maybe us, and then we have a huge debt for the rest of our lives of company to just pay it off. And meanwhile, there was this huge trend of cryptographic assets or digital assets that people were buying whatever they could bought. And we saw this huge difference between the demand and supply. And like 2 or 3 years ago, demand was way higher than a supply, and the gap of these crazy price increases and then a market correction, as we all know. So we simply saw there is, this link of combining these two together, because there is a demand. We saw it, and it fits with our vision. And I do believe that one of the reasons why these people were buying was because they want to own it. Of course, they were speculating on price increase, etc., but they could keep it in their wallet. They could track their ownership. They simply had this good feeling of owning it, and that's why they also started to care about it. They started to involve in communities, in etc. things. So yeah, so we combined these two together, spoke with Klaus at that time. We found out there's such thing as real estate tokenization, and started to work on our first project. And it unlocked us this hidden liquidity and also provided us with the opportunity of targeting this new audience, millennials, Generation Z, which would like to own something. And if it goes like it goes right now, the ownership of real estate, it's just farther and farther away from them. Because, well, houses cost 100,000 now. In 20 years, it's going to be what, 200, 300? No, nobody knows, but we all kind of know it's going to be higher. And this difference between what you can offer now and years from now will increase. So this new target audience is kind of once why we also chose to tokenize. It's also fit to our business model that if we have a rent, for example, of $1,000, half of it or even more, up to 70% sometimes, is just going to be paid to the bank to pay back your debt, your loan. So if we don't have that one, so you can actually save, up to 70% of the rental payments. Of course, we have another cost, but still we can cut maybe 20 or 30% down. So good housing, less costs, perfect. We saw it's a still blue ocean market, meaning that there is no competition, almost. And there are always going to be early adopters. And again, we saw there is a demand from the new target audience. And we also simply believe in mass adoption of Web3. Also, we saw that by the largest technology providers are starting to integrate blockchain-based digital wallets or digital custodian services, etc., 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 by ending up central banks issuing their own central bank digital currencies, which essentially same principles, just centralized, staking and such a things, but it's still Web3. So these were the reasons why we did it, and I would like to tell a little bit more about. I hope you don't see this bar actually in the front. About the first property. So as mentioned, it's located in Vejle, Denmark. For us, it was very important as well that we, as you know, we increase the value of the property by doing it, not just by tokenizing, but by doing actually the work. And so we decided to how we gonna keep some stake of the property, how we make sure that the property is not overvaluated by the stake we keep to ourselves. So we decided that we're gonna only keep the stake or the value of the stake, which is 20% by us and by partners, by how much we can increase the value of the property. So that was the challenge for architects, for construction engineers. Okay, we're gonna do good housing, but we should increase the value of it by the 20%. And we came up with the solution of splitting addresses from 3 to 5 by renovating itself, because it's an old house. So it gave us this margin of 20%, which we could keep to ourselves. By the legal framework, it's a SPV structure, owning the property. We issued the shares equivalent 1-to-1 to amount of tokens, and started the public sale of them. I actually have a good video of the property, and I hope it's okay for you to watch it. Oops. So this is the house. We decided to take half of the house away and rebuild it, since we're not sure what's about the fundament. Splitting addresses from 3 to 5. And it's good to show to people the real property, which you could have, because sometimes you go to the cities and you're seeing these houses, but you're never going to buy them, because this house would be around 2 million euros ready property. And that's a very small amount of, even in Denmark, small amount of people could actually afford to buy 2 million euro house. But by the tokenizing, or just making this as a fraction, it's possible for you to come and buy it for whatever amount. I mean, in our case, starting from 100 euros. So that was the way you could actually buy, or own the properties you could never own in your life. DAO is just, a little fraction. And that also fits the vision that real estate, in our case, when you work on something as a product focused, which we are a product focused company, we do believe that it's becoming it's not a luxury product. It should be accessible for everyone, because you shouldn't work for it like half of your life and then just pay off for the rest of your life to use it. So we wanted to make real estate as simple as a consumer product, which you can buy for whatever amount you want, and when you want, and where you want, and sell. And real estate has this good feature of being price increase during the time. Let's go down to tokenomics. These are probably the most important thing we notice people like to see about our properties. We chose, as mentioned, give away 80% because we are sure that we increasing the value of the property by 20%, meaning that all capital needed to develop the property we are raising from public, and that's 80%. We can go back to tokenomics after in a Q&A session as well, but this is the simplest tokenomics we could came up with. There is a ownership or management, stocks or shares, which we did not tokenize simply because we are not selling them publicly, and the rest are the ones which could be sold and tradable on the public. As mentioned, we are a product-focused company that it took a lot of us to actually build the product. And right now we are an ongoing public sale, which is happening 1 year. And everyone willing to own a little bit of Denmark are willing to visit our website and take a look more on the property. I am very much actually looking forward to trading part, which was discussed a lot by the experts before. We do not have also, as far as I know, centralized security token exchange with a lot of liquidity, where property owners or investors could come and connect their wallets and sell instantly their token holdings. So we will provide secondary market on our own platform, peer-to-peer, or a bulletin board principle, where one shareholder could offer his shareholdings to another one. And that's probably the solution. I can see it happening here and will be here for years until the big players as market makers or liquidity professional providers will come and boost this secondary market at the level where it's sell buy instantly. We actually looking forward that very much, but I see that's a trouble could be with when you're dealing securities, different type of securities with the different legislations. But I'm very curious how this will happen. I see myself how this will happen is just by brands, by businesses. They're growing that big that they offer these secondary tradings in their own platforms, and you simply know it's working good. They have good platforms. They work in 5-10 countries, and they simply provide the services themselves rather than third-party secondary exchanges, for example. Thank you. That's a short presentation about us. a small real estate developer from Denmark. And if you're willing to learn more about us, you are always welcome to contact me on LinkedIn. Just write me the direct message, or all emails is on our website. Thank you. Was short presentation about us.
Thank you so much, Kristaps. I see there are two questions for you, one in the Q&A section and one in the chat section. We do have to move forward just for the interest of time, but if you could answer in writing to that person, I think to those people, I think that would be appreciated.
Absolutely.
Thank you so much, Kristaps. Next speaker, Gary Rommel, attorney at Alamer Law Group, PC in California. What are the legal requirements for an issuer to tokenize a securities offering and enable secondary trading? So US specific. Again, Gary, yeah, the floor is yours.
Oh, thank you, Gabriel. Thanks. Let me introduce myself here and answer your question. I didn't know we were doing presentation, so next time maybe I'll have one ready. Let's see. Okay,
not mandatory, so as you wish.
That's it. That's it. So I would share my screen, but yeah, Gary Rommel, I'm an attorney here in Monterey, California, with Alamer Law. We specialize in kind of everything blockchain, from forming the corporate entity that's blockchain based, to executing the security token offering, to advising kind of all of these platforms on what they can and can't do with US law as it interfaces with everything. My background, I was in the Air Force for a number of years. I was an airborne computer specialist aboard AWACS aircraft. So I ran the airborne computer networks and put out fires. I got tired of going to war, so I went to law school a number of years ago. Geez, more than a decade ago. I went to Loyola Law School in Los Angeles. And now I specialize in just securities, business law, and blockchain. So to get to his question, he said, what are the legal requirements for an issuer to tokenize a securities offering and enable secondary trading? So let's take this as a two-part question right before that and. So what are the legal requirements for an issuer to tokenize a securities offering? So we'll take this in two parts. If you have an existing company, the first thing we need to look at is jurisdictional requirements. Does your jurisdiction allow for that entity to be represented on a blockchain? What does that mean? That means with a corporation, your capitalization table, your stock is represented by a security token on a blockchain. If it's an LLC, it's membership units. Those membership units are represented by a security token on a blockchain. So there's certain jurisdictions in the US that are very friendly to this, and there are some that are not. And there's a number of them changing. New Hampshire, Utah has some legislation being enacted, Wyoming, even California has some. There's different kind of entities coming up, like the Dow LLC in Wyoming, for example, the Doe, that have different aspects to us who can manage and control it. But even with a traditional entity, a traditional corporation or LLC, we can tokenize that cap table. Now, we can have that token represent the security directly, like it's a digital asset security, or it can represent just sort of a carbon copy of that, essentially a dematerialized, digitally enhanced security. So it's just sort of a copy running on a blockchain. Instead of having just the cap table on your attorney's computer, it's now stored on a distributed encrypted ledger. And if somebody breaks those copies and tries to update it, everybody knows. So it's a more secure method of doing this. And obviously it can help with liquidity later. Now, we talked about, so is it the jurisdiction that allows that? Number one, if it is, okay. And if we're starting the company, we can pick our jurisdiction. If we're reforming it, I can also help you reform it in a friendly jurisdiction. So the jurisdiction's friendly. We've done it there. If we already have our corporation formed or LLC formed, I can help amend the documents to reflect this. So this can be done later. It doesn't have to be a brand new company to do so, unless you're in the wrong state. Now, the other thing we have to look at is what kind of security token offering is it? What kind of securities offering is happening? Is it a registered offering or is it an unregistered offering? When we're talking about US law, those are the basic two worlds. Now, some people like to distinguish like a private placement and a public offering, and there's some exemptions like Regulation A, Tier 2, that blurs those lines between a public and a private offering. So I find it very helpful to distinguish between registered and unregistered. Now, a registered offering is a full IPO. Right, you're filing, you're going public. You can list on NASDAQ, you can list on New York Stock Exchange, and that's generally not what we're talking about here. That can be done, but a lot of people are doing private placements and utilizing exemptions to raise. So, what exemptions are there? For example, I believe Richard brought up Regulation D. That's a very common one for private placement. Regulation D, you can raise an unlimited amount of money to accredited investors if you're using 506C, and you can actually advertise. The Jobs Act sort of changed things with solicitation. You didn't used to be able to advertise. You still cannot with a 506B under Regulation D, but you can advertise to the entire world or the entire United States, the entire world, as long as you're only selling to accredited investors. So there's an accredited investor verification that can happen. And we're building these things into the platform with DigiShares. So your KYC, your AML, your accredited investor verification, your onboarding can all happen on that platform before that token is allowed to transfer. So that's an extremely helpful and efficient process. Regulation D, I often run this concurrently with Regulation S. Regulation S is, say you're a US company and you want to raise money from foreign investors. Well, the SEC doesn't really care about protecting foreign investors. So we don't have to file anything for Regulation S. We just have to make sure that we're separating those offerings, and a US investor cannot access that offering, because for Regulation S, you don't have to be an accredited investor, but those have to be bifurcated and there has to be firewalls up. So US persons can't access those offerings as non-accredited investors. Another regulation is Regulation CF, crowdfunding. This is kind of the excluded middle because regulation crowdfunding allows, it's not unlimited, allows for up to $5 million in a raise through a retail investor. They don't have to be accredited, but it has to be done through a crowdfunding platform, through a FINRA registered platform. Now, broker dealers can register these platforms, but a non-broker dealer can actually do this now, go through the process and register that. The problem with the CF is that you have to have audited financials. That platform is going to want to take a percentage, right? So there's limited reward, and the legal paperwork of the hassle for doing it is sort of right in between a Regulation D and a Regulation A. Now, Regulation A is what we talked about when it sort of breaks that between a public and a private offering. It sort of breaches that exception. So it's not a registered offering, Regulation A, and there's Tier 1 and Tier 2. Tier 2 is what we usually use because it bypasses state blue sky laws. Much like Regulation D, we just have to worry about notice filings with states. I don't have to vet everything with each individual state's securities divisions. So that's much more beneficial. Regulation A, it's a public offering, and it's just another animal. But we can do this as a tokenized step. US law is very clear. I am not at all unsettled by doing any sort of a security token offering. We're treating this like a security, and there's a playbook for this for us here. So we talked about, requirements to tokenize the securities offering. So again, by tokenizing it, we've made that company's cap table, that stock, that LLC membership unit, we've turned that into a blockchain token. Right now, to sell that token, we have to do the proper securities paperwork in the United States. That means an equity subscription agreement. That means proper disclosures, ideally an offering memorandum, basic SEC filings, unless it's a Regulation A, and then it's obviously more extensive SEC filings, and we have to wait. So those are the first two. We've done it. We've done the company. We've done the offering. And now what about secondary trading? What do we do in this process to enable secondary trading? Well, during the formation process, a lot of corporate documents are boilerplate, and there's provisions in there that stop secondary trading or that stop membership transfer or sale with an LLC per se. So those documents, say your company, if you're a corporation, your bylaws will need to be gone through very particularly, very methodically to ensure that secondary trading will be enabled and under the conditions that you want it to happen. There's a number of regulations that resales can happen, say in private offerings, and it's good to narrow those down because there are some riskier regulations that people use, some more expensive and more entangled. And if we're setting up a system, we want it to be uniform. So if it's an LLC, we'd want to edit the operating agreement, for example, to make sure that secondary trading was there. So when somebody signs up for the LLC, and the same thing with equity subscription agreements, that everything reflects properly those resales. So when we're talking about secondary trading rules, when we're talking about private equity, there's only a number of rules that people use. The 4A 1.5 exemption is sort of a legal fiction that was created a number of years ago to allow secondary trading. Now, this is the riskier one. This is the one where after a number of months, and lawyers recommend varying degrees to play it safe, they're pegging it at 6 now after 4A 7, and you need an opinion letter from the attorney to make sure that they're not essentially, the person is not acting as an underwriter or a dealer unlawfully. And those opinion letters are difficult. A lot of people don't want to do them because it exposes attorneys to liability. So for that reason, 4A 1.5 is sort of an unused resale rule. 4A 1.5 was codified by section 4A 7. And 4A 7 is just that statutory rule that says, the purchaser has to be an accredited investor under Rule 501A of Regulation D in order to purchase. And that person must wait a period of time. They must wait at least 6 months. Now, another rule, now keep in mind with 4A7, the resale must be to an accredited investor. Another rule that people like to use, and my favorite rule for private securities, is 144. 144, Rule 144 defines when a person is an underwriter and thus clarifies when control persons as well as holders of restricted securities may sell into public trading markets. This is viewed as the exclusive means for control persons to resell securities into markets. So Rule 144 may even be used in a public offering for control persons as those means, but it's always used, it can be used in the private context. There's also Rule 144A. Rule 144A is essentially the same rule, but it's for qualified institutional buyers. Qualified institutional buyers is any institutional investor with a securities portfolio of at least $100 million of securities, or a securities firm with a portfolio of at least 10 million. So if you're playing in those kind of leagues, you can use that rule. These things need to happen on, like I believe Richard spoke, on a lawful exchange or an ATS. And I'm very excited for the Q1 next year for DigiShares to be plugged into Tetra Capital and these blockchain platforms getting connected up, and Liquidity being very much more accessible to us in this context, and making this entire process for the investment world much more efficient, and we won't be bleeding money on middlemen as much. So yeah, I think that covers it. And like I said, to enable rules, the resales on these rules, we just need to make sure the equity subscription agreements and everything is tight, and it's the way the issuer wants it to be.
Perfect. Thank you so much, Gary. Great presentation. Yeah, we're definitely also looking forward to the launch of realestate.exchange, targeted for Q1. And yeah, it's always a pleasure working with you, Gary. And I know a lot of our clients work with you on legal matters in the US. Yeah, it's not often that you have an attorney that has such strong knowledge on smart contracts and things like that. So we appreciate the partnership. All right, on to the next speaker, Volodymyr Havriluk-Jensen, who's our legal counsel at DigiShares. He's going to talk about the legal roadmap for tokenization, I guess, with a focus more on jurisdictions outside the US. So yeah, Volodymyr, the floor is yours.
Thank you, Gabriel. Thank you. Hello, everyone. I don't know, can you see my screen?
Yes, we can.
Okay, perfect. So yes, hello, everybody. As mentioned, I'm Volodymyr Havriluk-Jensen. I'm the legal counsel at DigiShares. I will try to keep my part short and sweet. It will be focused on the EU, so more regulatory perspective from the EU. And it's meant to give you some sort of different perspective from the US, because we have heard now a lot about the US regulatory framework. We heard from how secondary market venues work, and also from Gary about the issuer's perspective, how they can issue tokenized securities. So I will focus on how the EU regulations have first prohibited secondary market liquidity, and now with the new regulations are hopefully enabling it. And I will put it in the context of what we're doing with the real estate exchange here in Europe. So secondary trading venues in the EU are primarily regulated by Markets in Financial Instruments Directive 2, MiFID II, which sets out for two largest categories of trading venues. So it is MTFs, multilateral trading facilities, and OTFs, organized trading facilities. So an MTF can be compared to somewhat to an alternative trading system in the US that Richard spoke of. MTFs, as the name might imply, apply to multilateral trading, which occurs where multiple buying and selling interests interact within a system. So it's a very broad definition. You know, the classical example would be, just think of a traditional order book system with automatic order matching, like you have on big stock exchanges or for crypto assets in Binance. That would be a sort of textbook example of multilateral trading, but it's very broad definition, so it could capture different types of trading, including, for instance, trading using an AMM, automated market maker. So organized trading facilities are also multilateral venues, but they're for specific types of financial instruments like bonds, derivatives, and emission allowances. And of course, other types of trading are also captured. So over-the-counter trading, OTC, different types of transactions that may be brought about by investment firms, which, if I have to make the analogy, then that would be an EU version of US broker-dealers. And so the main point here is that there is obviously an extensive framework, but it was designed with the legacy capital market infrastructures in mind. And so it split different trading processes between different service providers, record keeping of transactions, settlement, and safekeeping of securities that are listed on an MTF would not be handled by the MTF itself. They would rather be handled by a central securities depository, a separate institution that would be carrying out those functions. Same would be the case with clearing, so counterparty clearing houses would be typically involved, and this makes perfect sense in view of legacy capital market infrastructures. But the opportunity or the challenge, depending on how you look at it, with the DLT is that DLT-based trading venues are capable of merging certain post-trade processes like settlement and clearing. So a DLT application could have execution, settlement, and clearing all conducted simultaneously and practically instantaneously within one system. That could be done, for instance, through an atomic swap transaction. And inherently, it could perform some of the functions that these intermediaries perform, like record keeping. So DLT is an immutable ledger that could store and update information potentially much more effectively than just a separate institution like a central securities depository could. And so EU recognizing that there is a need for an overhaul of capital market infrastructures has introduced the DLT pilot regime regulation, which is a new regulatory framework tailored specifically towards DLT and blockchain applications. It's a regulatory sandbox that aims to sort of test the different regulatory approaches and different DLT applications in the secondary market transaction space. And so it does that by removing some of the regulatory, the legal obstacles to the use of DLT in secondary market transactions, and by providing legal clarity by introducing sort of new concepts, new definitions, and new categories, one of which the primary focus for us would be here, DLT MTF, which is still an MTF under MiFID, what I mentioned at the beginning, similar to US ATS in some regards, but it operates on the DLT, and it benefits from a number of exemptions from problematic requirements. Particularly, it is capable of merging post-trade activities of CSDs, so recording, settlement, and safekeeping of securities listed on the DLT MTF could be performed by the DLT MTF itself or its systems, and certain intermediation requirements have been removed. And on the CSD side, we have the DLT security settlement system. So if we look at the bottom of the slide, we have a comparison table that should give you maybe a little bit more practical understanding of the obstacles that have been removed and what has been blocking secondary market liquidity in the regulatory space in the EU, at least. So traditionally, an MTF would have its securities recorded in book entry form, which is a specific form. It's a formalistic requirement with the CSD. A DLT MTF records its securities on the DLT, and it requires no CSD because the DLT performs the record-keeping functions, and settlement of the transaction can be carried out together with the execution through, for instance, an atomic swap. A traditional MTF would have certain intermediation requirements, like, for instance, that natural persons cannot be participants of an MTF. They cannot directly access a security settlement system. Natural persons wouldn't be able to provide liquidity to an MTF, at least directly. And this is problematic, especially in the context of decentralized applications, decentralized finance, where investors and users of these trading platforms are designated a much more active role in the securities transaction process, and just in general through, for instance, provision of liquidity in the business model. And so the DLT MTF removes that requirement and allows natural and legal persons to be admitted, so they could directly interact with the security settlement system. They could connect their digital wallet to the DLT MTF system and have the securities transactions settled directly from their digital wallet, or they could provide liquidity directly, but requiring no other intermediaries. Of course, the DLT MTF is an intermediary in itself. And so the traditional MTF would also have the requirement of cash settlement. What that means is that a security settlement would have to happen through the delivery of fiat currency. And this is very problematic for many DLT applications that necessitate the use of tokens on the payment leg of the transaction for smart contract functionalities. So DLT MTF removes that requirement and allows tokens to be admitted and used for that purpose. And so what we are left in the end is a much more efficient capital market infrastructure that uses DLT, that doesn't technically require the use of central securities depositories or clearinghouses. So that's on the regulatory side. And then to put it in the context of what we are doing with the real estate exchange. So as you may have heard at the beginning, we are working on two different versions of REX, which I unofficially designate 1.0 and 2.0. So the first version of REX that we have built and that will soon launch in the US, and we're looking to bring it thereafter to Europe. It would function, so it would have the same functions in Europe as in the US. It would be the direct peer-to-peer trades, non-custodial, primary and secondary marketplace, allow for both fiat and crypto payment. In the EU, it would be operated under investment brokerage license that can cover entire EU, EEA area, allow for both retail and professional investor participation, and allow international issuers to list, so not only US and EU, but potentially from any part of the world. And REX 2.0, so Richard already mentioned a little bit about automated market makers, so it will be based on the AMM, and you will hear more about that from Mark on the technologies presentation that is coming up next. So, you know, in layman's terms, an AMM-based exchange essentially functions based on liquidity pools of pairs of two assets, so tokenized security on the one hand, and crypto asset, for instance, stablecoin on another, and the AMM, the automated market maker, through mathematical algorithms facilitates the trading against the liquidity pools. And the participants in the platform, of course, can provide liquidity. So that's the decentralized finance aspect of it. Again, it's the same concept. It's primary and secondary marketplace, but we envisage it to be operated as a DLT MTF under a DLT arm, again, covering entire EU, EA, retail and professional investors, and international issuers. So that is all from my side. I am looking forward to the fireside chat and would pass it back to Gabriel.
Thank you so much, Volodymyr. Yes, see you at the fireside chat. So the next speaker will be Mark Denker from the Real Estate.Exchange team. He will talk about how real-world assets are moving from narrative to dApps with product market fit to their own chains. So Mark, the floor is yours.
Yes, hello everyone, or evening, wherever you're sitting and tuning in from. Thank you, Gabriel, and I as well would like to share a presentation. So I just share my screen, or how's the best way?
Yes, feel free to share your screen.
Yep. Super. You can see my screen now?
Yes, we can.
Beautiful. Awesome. Guys, I won't be dragging on for too long today, because I know it's been a long session, and you guys probably need to stretch your legs or grab some more coffee or whatever before the panel debate. But I'm here to talk a little bit broader than I usually do about where we are in the space for real world assets. But of course, name is Mark, one of the creators of Real Estate.Exchange. Basically, we are created and set in this world to enable anyone, anywhere, to buy, sell real estate on chain. That's really what we are trying to accomplish with Real Estate.Exchange. Anyone who thinks about buying and selling, trading real estate on chain in the future should think about us. That's the ultimate goal. But of course, we are not living in an isolated island. We are part of a broader ecosystem, which we generally refer to as real world assets, RWAs. Of course, DeFi, as we all know, has been through a pretty tough bear market. But despite that, we actually see some light at the end of the tunnel. What you see here in this presentation is a screenshot from DeFi Llama that most of you probably know. Some of you might use it on a daily basis to look up your favorite chains and what's going on-chain metrics. It's a very useful tool, at least for that kind of stuff. And as you can see under the category RWA, and in this case, TVL rankings, total value locked, in a raging bear market, you still have some pretty large protocols and dApps that has attracted quite a number of dollars in total value locked. At the top of the list, I don't know if you can see this, it might be a little bit small, but you have Maker and STUSDT attracting a total of almost $5 billion, which is not a small number, obviously, especially considering the market. And then you have a long list of other projects who have perhaps not attracted billions, but it's in the pretty large million number. There you got Ondo Finance, Matrix Doc, Realty, a lot of projects basically building Mabel, of course. So we talk about RWAs, and obviously most people joining in today, they would think that RWAs is something that is exciting, something that holds potential, but it's not just hot air. It's not just a narrative. It's actually something that could be the next big thing, pushing the industry forward. I think the numbers are there to show for it, and we can only imagine what's going to happen when the bull market starts to kick in. And the question then remains: will we be ready when that happens? Because it's not a question of if; it's a question of when, as we all know. Last time we saw a bull market, which many of you probably experienced, including myself, we saw how a lot of market participants, for sure, that was the case for me, we simply got priced out because of high and spiking network fees. The graph that I show you here is basically the Ethereum gas price, so how much you paid for submitting a transaction on the Ethereum network. And you can see it was on average quite high during the DeFi summer in 2021. Spiked very much some days. And then it started to flatten out after the DeFi summer ended and the bear market entered. So what has happened? So the market has changed, of course. Also, alternative networks started to pop up. Solana, Avalanche, Luna, Tron, and many other alternative layer ones, as they were called. But in the meantime, during this whole bear market, Ethereum has not been standing still, that's for sure. They managed to deploy all these different chains on top, layer 2s, as they're called, on top of the Ethereum network, where they essentially rent security from the Ethereum validator set. Popular examples of this is obviously Polygon, Gnosis, Arbitrum, arguably also Optimism, and many other layer 2s. It feels like almost on a daily basis, some chain or project announced that they are going to build an Ethereum layer 2. Worth mentioning also is Cosmos, that from the beginning had this thesis of an app chain thesis where all chains can communicate via something called IBC. So you can move assets and communicate between chains seamlessly, but you still deploy your individual sovereign chains using the Cosmos SDK. So what I'm trying to say with this is that what has happened since last bull cycle is that we started creating the foundation for deploying many different chains. And as a result, we managed to create a lot of block space, meaning that when the next bull cycle starts to happen, we will not lack block space. There will be plenty of block space. There will be plenty of networks, plenty of chains where you can add your transactions. So we will not see the same spikes and the same high average trading fee or transaction fee that we saw in the last bull cycle. And this is very positive because that was predominantly what was holding crypto back for many people, being priced out simply from participating in the network. So what does that have to do with RWAs? Well, I think it's kind of a big deal. Real world assets obviously involves a heck of a lot of assets. Everything is in the real world, really. And we need to bring that on chain. We need to bring that to the digital realm. We can only do that if we have enough block space where people can participate and not getting priced out like we saw last time. So the full list of this RWA TVL ranking that I have from DeFi Llama, it only includes 30 dApps, 30 applications, decentralized applications, which is not a lot, right? There's certainly more use cases for real world assets than 30 dApps. So what needs to happen is we need more projects. We need better product market fit for both existing projects and new projects. And I can only speak for myself, of course. We need to obviously go to market, improve on our product, and continue honing in on obtaining product market fit. Most likely, this will happen on Ethereum or some layer 2 on Ethereum. The arrows that I put in this screenshot here for Maker, for STUSDT, for Mabel, just indicates that those top 2, for example, they use Ethereum. Mabel uses Ethereum. Most people use Ethereum. This is where all the action is, really, all the liquidity is. So it makes sense to start there. And that's great. You know, if you can find product market fit on Ethereum, by all means, you know, go do that. But as the network starts to congest, as network fees starts to increase, there will be more and more incentives to move on to another chain, or perhaps even deploy your own chain. And in particular, the part about deploying your own chain, once you have product market fit, is a very, very attractive thing to do, especially as an RWA project or DApp, because there are specific needs. We talked about during this webinar a lot of the regulatory and legal requirements that we have to actually operate. All that could be built in to a network or blockchain that is deployed specifically for, just in our case, the brick network. We can specifically build in, for example, whitelisting features and all these different things that we need in order to comply to various regulation. And when we do that, because again, it's not a question of if, it's a question of when. So once we have found product market fit, attracted a certain amount of liquidity and trading volume, that's when we start to think about deploying our own network, deploying our own chain. And there's plenty of options out there. There's Ethereum layer 2s that I mentioned a number of times. There's Avalanche subnets, there's Polygon supernets, there's optimistic rollups. I mean, the list of names, there's no shortage of that. There's Cosmos app chains that I also mentioned, all of which has the same sort of criteria that they are proof of stake chains. So many of you know, after the Ethereum merge, Ethereum moved from proof of work to proof of stake. That seems to be the winning consensus mechanism across the blockchain industry. The only chain really remaining that people are using on a daily basis is Bitcoin, still using proof of work. So yeah, any of you interested in consensus mechanisms, that's proof of stake is the way to go, it seems these days. So is all this just something that I am pulling out of somewhere, or is this actually something people are doing? Like, are people actually who has found product market fit, are they actually considering or even building their own chain? And the answer is, surprise, surprise, yes, there is. A good case study, a good example to just underline this is DYDX, the biggest perpetual exchange, this decentralized perpetual exchange in crypto. They recently actually not just announced, but deployed. So they announced last year, I believe in September, and it took them about a year to deploy their own chain using the Cosmos SDK that I referred to a few times. So perpetuals, for those people who are unaware, is basically what made FTX very big. They're futures contracts that don't expire. So yeah, to avoid having the next FTX in the next bull market, it's probably good to get this right. And it's great that DYDX is building their own chain to really cater for their specific needs in the perpetual space that they're in. So yeah, DYDX went ahead and built their own chain. What I highlighted here in red, if you can see it, it's probably pretty small, is that the DYDX writes, quote unquote, the main requirement for the protocol is full decentralization. Decentralization of a system is equal to the decentralization of at least of its decentralized components. This means that every part of the protocol needs to be decentralized while also remaining performant, meaning they are going out and getting validators to validate their blocks. They're building their own network specifically for their own chain. So this is pretty cool, and we will definitely start seeing this more and more, hopefully, for sure, also in the RWA space. And just to show you one benefit of this, the rules that you can set when you build your own chain. Antonio, the founder of DYDX, recently tweeted out, as you can see here, for 14th of November, so a week ago, that stakers, so if you buy DYDX tokens, you delegate to a validator, so they have a number of validators validating blocks. That's how proof of stake chains work. So let's say I hold DYDX tokens, I delegate those tokens to a validator. When I do that and stake those tokens, I get USDC stablecoins as rewards. So, you know, blocks get validated and stakers, they get rewards for that, just like when you mine something on Bitcoin and proof of work. But here they set the rules to pay out in stablecoins, in USDC. So there's all these different features that you can build into the chain, which can either be for regulatory reasons, it could be for making it easier for potential investors in your token to understand what is the ROI, the return on investment. So all these different cool things that you can really do to to enhance your product market fit. So yeah, I think DYDX, they're doing a stellar job. They've been doing that for many years. That's why they're the biggest perpetual decentralized exchange out there. They just continue to kill it. I think it's a good example to show for, yeah, not just perpetual exchanges, but also for RWA projects like ours. So yeah, real estate exchange is it's going to be interesting to see who the first RWA DApp will deploy their own sovereign chain. We will certainly do ours to get there. But first, of course, we need to go live. We need to find product market fit, and only once we have gotten all the learnings from deploying on Ethereum that we will start out with, then it makes sense to start considering building your own chain. In our case, using the BRIC token as the governance token and the native token of the network. And we will most likely call it the BRIC network. So yeah, as you can probably hear, guys, my voice is breaking up. I've been sick for the past week. So I'll stop there and then let the questions come in shortly after if anyone has any follow-up questions on this. Well, thank you.
Thank you, Mark. So we will move to the fireside chat part of the webinar. So if all of the speakers could activate their cameras and sound, that would be great. And as people do that, and as Richard pointed out in the chat, we have breaking news here. So some pretty big news. Binance founder agrees to step down, plead guilty. I'm reading the Wall Street Journal front page. The crypto exchange to also admit wrongdoing, agree to pay $4.3 billion in fines. So he's pleading guilty to violating criminal US anti-money laundering requirements. So I guess this is to show the importance of abiding by the regulations and the laws. Yeah, it'll be interesting to see what effect this news will have. I know that the whole security token space has suffered from these bad headlines about crypto and people mistaking crypto with security tokens. So yeah, it was pretty surprising to see that. So as a first topic for the fireside chat, and this links to, I guess, which just happened, is the debate on the U.S. regulatory environment. So I know Mark Feidelman had some comments saying that the U.S. was really lagging and was a very poor jurisdiction for tokenizing real estate. I think some would disagree, such as Gary, maybe Richard, and others. So let's get maybe started with that, and maybe a response from Gary to what Mark said, and then others please join into the debate.
Yeah, as a response. Yeah, sorry, Mark, but you're wrong.
Oh, that's first shots fired.
That's it. Sorry about that. But the attorney has spoken.
I'm wrong.
I've spoken, but no, there really is not ambiguity. It's a security, right? If we're dealing with a cryptocurrency, of course, like I've told a lot of potential clients have come to me, or clients, and they have this big, and they have this big, huge spreadsheet and all these diagrams. And at the end of the day, it's either a security or a cryptocurrency or a stable coin, right? Or a utility token. There's different kinds of things, but they try to make it one thing and it ends up being a security, right? And we're talking tokenization of real estate. It's a security. And that's fine. We can deal with that. If I can tokenize a US entity with corporate law, if I can represent that on a blockchain, that equity on a blockchain, I can sell that equity under the regulations or the exemptions from regulations, just like I could any other security, right? It's just a matter of, am I trying to put it on a decentralized exchange and sell it unlawfully and not through an ATS like Richard's, or am I actually selling it through an ATS or an exchange as a security? If so, it's fine as long as we play by all of the U.S. rules. We're very solid, and in fact, I think we're a lot more solid than other jurisdictions that have ambiguity. Like there is a path forward here for a securities token.
Yeah, I mean, I would comment on that as well. I think I agree that there is a path forward. It's a narrow path. I would like it to be wider. I'd like to be able to do more things, but we absolutely have a path forward, and that's proven by the fact that we're able to tokenize securities, whether it's we've seen equity, we've seen fixed income, we've seen revenue share. You can use Reg D and go to accredited investors. You can use Reg A. Using Reg A now is a little bit more straightforward. There was a lot of question marks around that back in the beginning when Stacks did their first security token offering. That took them a lot of time. I think they spent $11 million in legal fees or something crazy there, but thankfully they did kind of cut the trees down for the rest of us to follow that path.
And I thank them for their work. I have all their files.
Exactly,
ChatGPT has analyzed it 1,000 ways for me already.
Oh, that's a good idea. I'll do that. So I think a couple of areas I would like to see more regulatory progress on, and one is custody of digital securities and security tokens. I don't think they fit into the tried and tested securities regulations, because custody was originally when they set up most of these regulations, custody meant you take a piece of paper, you take the elevator down to the basement of the bank, and you put it in a big vault and you close the spinny wheel thing. And now we have, of course, these assets are digital, and the concept of custody has changed. So I think we should definitely have an update there, and I think we should have more clarity around stable coins, because being able to use them on the ATS for settlement, that's a game changer pretty much. Then you've got like atomic settlement, and that's what we all
want. And Richard, did you see the CPMI report just came out in October? I think it was October 31st. Considerations for the use of stablecoin arrangements and cross-border payments. I've got that.
What does CPMI stand for?
Committee on Payments and Market Infrastructures.
Okay.
That might be instructive.
Well, I've got my Thanksgiving taken care of then.
That's it. You're welcome. Turkey Day.
All right.
Yeah, Mark, please. Yeah,
I'll jump in. And I want to remind people what's happened with our SEC and FINRA just in the last year. Richard talked about $11 million in legal fees to prove, and get past all the regulations into becoming a security token. That alone, I could rest my case. Okay.
So I'll do a Reg A for 65,000.
All right. Anyway, but Reg A, why do we have to do an exemption? Why aren't there rules like there are in Dubai and in Europe where you could just follow them and get it through? Why are we doing exemptions? But I'll get to that in a second. The SEC declared Ripple a security. A judge said they weren't a security. Oh my God. Well, what is going on in this country? We have no clarity as to what's a security and utility. And I know there's some clear use cases. These meme coins are ridiculous. But Ripple beat the SEC in court. The SEC said it was a security. Ripple said it wasn't. Judge said it wasn't. Where's the clarity? There's still a ton of ambiguity. It's because the SEC will not issue what the UAE and Europe.
Ripple wasn't trying to operate as a security. They weren't saying I'm a security token. I'm a corporation with a tokenized cap table who's doing a Regulation D offering. They tried to evade being a security. That's the problem. We're not trying to evade being a security with a security token offering. We're saying this is a security. We're playing within these rules of securities law. And I'm sorry if you don't understand those rules, but we're playing within those rules and we're fine. We're absolutely fine. It's when we try to be something else, when we try to be a cryptocurrency and we try to be a utility token or a stable coin and operate an exchange, that's when the rules get fuzzier. But on a security
wait a second. Attorneys.
We're fine. I'm talking about a security token. Keep in mind. I'm just talking about a piece of equity that's represented by a security.
We have the same SEC and FINRA declaring things that they're not. So you don't have clarity here. They had to go to court.
I'm sorry, but we do. One of my strategic partners, Anne-Marie Tierney, she was an SEC prosecutor. She is currently head of the SEC Alumni Association, and both of us would disagree. There is clarity with security token.
If there was clarity, then why did the SEC go after Ripple?
Because, like I said, Ripple was trying to evade being a security. I'm not trying to avoid being a security.
Because they were right.
This is a security token offering.
They were right. I understand what you're saying. What I'm saying
Apparently
is
not.
even the SEC and FINRA are not clear about what securities are and what are not. And they're not willing to
They
issue
very
clarity.
much are clear. They
Well, they
very
lost
much.
in court. So
Where did you go to law
they're-
school, Mark?
They lost.
Where'd you go to law school? Where'd you go to law school, Mark?
I'm not in debate about legal.
I don't recommend you give legal advice on this topic. Thank you.
No one's giving
So
legal
I
advice.
guess just to summarize, I think there's a disagreement then on, what whether something like XRP is clearly that there are clear SEC guidelines for something like XRP. There's a disagreement here, but I think the argument on the other side is there are clear guidelines for something like real estate, like shares in a legal entity that represent real estate. So that's maybe where we can leave this debate, like summarize the disagreements.
Exactly. Security token is not cryptocurrency. It is not.
So let's get to that. Okay, so you have real estate security tokens. Let me tell you how it works in UAE. Maybe this will help. Okay, in the UAE, you apply to VARA. You say, this is what I want to do with it. They approve it. You get a license. You can do it. Here, okay, what are the DeFi regulations in the United States that I could follow for security tokens of real estate? Can I have them staked and issue dividends? Can I issue interest? Can I trade them on secondary markets? You could go through exemptions, and Gary could probably figure out a way to get this done. But it's not.
I have figured out a way to get it. I'm getting it done.
Okay, but Gary, I don't know how much money you're going to spend to get there. One of the companies that we just heard about spent $11 million in legal fees.
Like UAE, I said, for Reg A plus, I do a Regulation D offering, a D and S offering for $15,000. A security token offering is a flat fee in the United States. I do a Regulation A plus for $65,000, subtracting the 15 if you've already done it. So that's 50. So it's not $11 million. I do it actually for less, and I augment my practice with AI. And I can actually do it for less. Half is less than most other law firms. Do just a regular Regulation D with no security token offering. My price is even less than that. So there is a path forward, and I'm sorry that you don't understand the difference, but there's definitely.
Hey, Gary, you could continue to insult me. That's not productive.
All right. So let's
you're giving misinformation out, and you're not an attorney. You're giving bad legal advice. And I'm sorry, but you shouldn't be speaking on the topic.
Nope.
These are great. This is a great debate, and generally webinar fireside chats are not as animated, so this is fantastic. But
that's it. I do have my Smith and Wesson pen for shots fired.
we should move forward on other topics, and maybe that's a great segue to like other jurisdictions. So I know Vladimir has experience. Kristaps, you've been through a process in Denmark. Would love to hear your guys' take on other jurisdictions, and like maybe what are some of the best ones to tokenize real estate.
Sure. Shall I take it then?
Please.
So yes, first of all, just reflecting on the US as a jurisdiction, if we compare it to EU, actually in the US for a security token offering, if you're just not doing anything very fancy, it would be a lot clearer in many cases than in many EU countries. Not all, some are very advanced, but in majority it would be. So at least in terms of, tried and tested path of security token offering, if we're talking, of course, a decentralized exchange, some DeFi applications that could be different. But, in European Union specifically, there's been a couple of jurisdictions that have stepped up. First and foremost, of course, on the EU level, we had an overhaul. We've had a groundbreaking MiCA regulation, which introduces sort of a comprehensive legal framework for the regulation of crypto assets. So that would be utility tokens, different types of stable coins, and other crypto assets. Financial instruments, so securities are specifically outside that regime. That regime still falls under traditional securities regulations. And here you need to sort of be also aware of the intricacies of the EU framework, how it works. So some of the competences have been taken away from the member state, and some have been left at the member state level. So where EU doesn't legislate, the member states can legislate, and where the ones that have chosen to legislate in the area that they do have the space to do that, They have sort of made amendments to their civil code, recognizing security tokens or different types of digital assets as potentially securities, bringing primary trading in primary market in order, for instance, in Luxembourg. In Germany, there's been a lot of regulation on the national level in this regard, including custody solutions for security tokens in general. So yeah, there's the leaders probably are sort of France, Luxembourg, and Germany in this regard.
Great to hear, and as a Frenchman, half French, it's great to hear France is leading in something when it comes to regulatory aspects. So maybe as a last topic, relative to the regulatory framework, something that we often hear is the regulatory requirements are such that as an issuer you have to disclose a lot about the business, and maybe a real estate developer, real estate fund doesn't want to provide information about their cash flow statements and things like that. And that is real dilemma and question. So how do you guys think we can reconcile these requirements with the advantage of providing liquidity to investors? I don't know who would like to take a go at that question.
Yeah, I mean, I think I think disclosure is a bedrock of the financial regulation system here in the US. And I agree with it. I think the point is, what the regulators should be doing is not telling people what they can and cannot invest in necessarily, but they should be making sure they have enough information to make an informed decision about what they can and cannot, what they're investing in. So and by the way, real estate developers everywhere, if they're raising money, they're disclosing this information. It's just a question of who they're disclosing it to. If they're doing it in a closed round with a Reg D, then maybe it's only 10 family offices and some high net worth doctors and dentists, which is fine because a lot of most real estate deals get funded through the Reg D exemption. But if you want to sell it to the public, or if you want a resale, then you need to make that information available to other participants again, so they can make an informed, the best informed decision. I think what you're right about is a lot of people do keep away from not even just real estate, but even like private companies, like startups. They're very, very secretive about the information they have, which is why sometimes they steer away from a Reg CF or a Reg A, which they could do right now. Probably a better option for them right now, given that the VCs have sewn their wallets shut. They should be looking at these types of things, but that is a concern because they don't want their competitors out there, seeing the information. And you guys, by the way, DigiShares, you guys are doing a Reg CF right now, so fair play to you. I think it's the right way to go. Get retail investors in there, try and democratize the space, as opposed to just keeping it, between different rich people.
That's it. And yeah, on the public disclosures, the holding periods, for example, with Rule 144, 6 months for reporting company, 12 months for a non-reporting company. In the comments, when they're debating those rules and they were thinking about even reducing that, is about public information. And this day, and they mentioned in this information age where everything's online, there's information parity. There's more information parity between, the initial investor and the resale. If you're giving all the same disclosures to the initial investor that's being handed again, and those updates are all online and all connected to the resale person, there's less concern with public information and what people know and what's being disclosed. And of course, like I tell all my clients, it's just best to be brutally honest and disclose everything possible to everyone at all times.
I think the interesting analogy kind of between the TradFi and the DeFi space is like DeFi or crypto, they'll have a white paper. And that says all sorts of things in it, and that is useful information, and certainly they raise a lot of money off it. But you got to go a lot further when you're talking about securities offerings with proper disclosures, risk factors, financials, conflicts of interest, all this type of stuff.
That's it. And I take a risk analysis with the IT view, as far as how can it be hacked, what can be hacked, how does the risk analysis vary from a public permission chain to a private chain, right? So all of these variables have to be accounted for, and a lot of the old boilerplate that people used has to be rewritten.
And Herwig, maybe what are you hearing from your clients in terms of this finding this balance between transparency and having the advantages of tokenization?
Yeah, no, I mean, I think at the end of the day, it's an easy argument to make when you have, especially in real estate, two very similar assets, and one is offering you more disclosures, more information, more transparency. You're going to pick that asset over the one that isn't. But at the end of the day, it's a free market, and some investors, they're comfortable with less information. And so for certain clients of ours, absolutely, they get concerned about having to share certain information or wanting to share certain information due to competitors. However, once again, that's where this technology can come into play, where there are ways to limit access to certain information or permission certain information to people, or even blacklist competitors from owning shares and things like that in a much easier fashion. For me, it's all the whole part of the narrative of tokenization and digitization is without a doubt bringing data on chain, bringing information to the masses. And I think Gary and Richard are spot on that, the information is what is needed in order for investors to make the right decisions and to be protected. And so in many cases, it's the right requirement. But it definitely it can be a little bit of an opinion as to, it's inertia. At the same time, we have clients that look outward and look internationally because the US, presents friction. It presents friction that, certain people don't want to deal with.
So that's actually a great segue towards one of the questions that was asked in the Q&A section about chain links, so oracles. How do oracles fit into the mix to provide that real world data to the smart contract and enable people to make more informed decisions, and maybe even automatically adjust prices of something if something in the real world happens. So do any of you have thoughts on oracles and how it ties into tokenized real estate trading?
I mean, yeah, I do. I have a lot of thoughts about this. I think it's huge, especially for real estate, because I think and we haven't even talked about this, Gabriel, but we certainly should schedule some time. A lot of real estate assets are going to be private assets. They are going to do a Reg D, and they're going to be an LLC interest. And there's going to be limited information available if you wanted to sell them on the secondary market. You're going to, you're going to be able to kind of see the original documentation. Maybe you can kind of get some idea of what rents are in the area around the property or whatever. Having that on chain, making it more accessible is great. But I also think there's a ton of alternative data sources that you can access now. For example, you're investing in an office building. Well, okay, we can attach to the blockchain, to the security token, what the kind of the mobile footprint, how many mobile phones are in that area? Has it been increasing? Has it been decreasing? What's the foot traffic like? You could attach satellite data, for example. There are companies who are in the retail scenario who are capturing satellite images of your shopping mall car parks on a Saturday and comparing that to the same day the previous year. These are incredibly valuable data points for real estate, and I think you can potentially make them even more accessible and more easily accessible in a tokenized world. And someone like a Chainlink would be the key partner to put those on chain.
Really interesting point. Does anybody else have any thoughts on how data ties in and helping investors make decisions? And
I think it's good. I think we're just data aggregation is just like you said. We can track self-mode movement, satellite imagery, and between interchain operability, things like Polkadot, different protocols. Things will be connected. It's just a matter of making sure they are.
Yeah, and I think, just to expand on my presentation, I think we need those in place in order to make sure that we're communicating on different chains, off chain. All these things need to come together and needs to be interoperable. I think we gotta put that in place sooner rather than later.
Great. Well, thanks for all of your feedback on that. So something, we've been talking about with Richard and something Mark spoke of in his presentation are real estate investment trusts, so REITs. So I just wanted to have the panel's opinion on whether tokenization will maybe help expand REITs, like private REITs. Will it make it more popular, or will it destroy REITs and like kind of replace REITs in a lot of scenarios? What are your thoughts on that?
Well, I'll start. I think if the liquidity's there, you'd be crazy to invest in a REIT because of all the middleman fees and you don't have direct interest in the real estate. A lot of times you're not getting dividends from these REITs. So yes, I think if we can provide the liquidity and we can make it more global, then REITs will either convert, or anything related to a REIT that is trying to go public will reconsider that and probably tokenize it instead.
I'll disagree with that. I think REITs have tremendous tax benefits, and that's why they're going to be around, and that's why they'll stay around.
In the US, yes.
Not the structure. It's not there's a real estate investment. It's just got tremendous tax benefits as long as they follow the certain rules. So I think people are always going to take advantage of that.
Yeah, I think it's just a matter of there'll be people that don't quite qualify as REITs, that will act as such, just normal real estate syndications that aren't quite REITs. And then I think REITs may go the way of tokenization. You might have people that do qualify as REITs that like the tokenization aspect and do it that way. I see it going both directions. I don't see it as an either or scenario.
I mean, think about REIT rules. Like you have to, prove that you have 90% of your distributions go back to shareholders. How easy is it if you can point to an on-chain ledger that does exactly that, right? So REITs, public and private, they're from an administrative perspective going to leverage tokenization. And then I agree, there with Mark that there will be new venues, new avenues where you can get liquidity. And so there will be reasons why you won't necessarily need to go public or seek a REIT structure per se. But at the end of the day, it is definitely about the tax benefits. So, REIT's just a tax classification. It has nothing to do with the entity itself in many ways. So I think you're just gonna see a rise of adoption across the entire public markets and private markets for REITs for sure.
Great points, thanks. So maybe as a last question to bring in Mark and Christoph's. So in Rich's presentation, there was a slide where he was comparing sort of the AMMs with the ATS, which uses an order book system. What are your thoughts, Mark, on how on where real estate will be traded eventually? Do you think it'll be 100% DEXs with AMMs, or will there be room for order books? And then Christoph's, like, where would you want your real estate tokens to trade on?
Yeah, I think it's interesting to see how this is playing out, because AMMs certainly were the kings in the last bull cycle, but we see more and more order books, classic order books, clubs, CLOPs coming up. We see perpetual exchanges, like DYDX I mentioned, that also is built on top, like basically as an order book. So yeah, who knows? I think AMMs are great for the simplicity's sake, this instant swap. You see what goes in, you see what comes out. It's very easy to understand for the normie who is not sitting there and watching charts all day. They're just there to swap whatever, a stablecoin into something that they find interesting to buy, whether that's a real estate asset or if that's a utility token or whatnot. So I think there's room for both. Which one is going to be the biggest? I mean, if history is any guidance, then it's probably going to be order books, because that's mostly what people use on exchanges. But yeah, it's difficult to sell. And really, I don't know. To me, the technology, whichever wins, yeah, personally, I don't really care. As long as the user experience is good and serves the needs of the user, that's the most important part. And the fact that we have both playing on an even field to centralized alternatives centralized exchanges, that's very bullish for crypto and DeFi and decentralization, I think, personally.
I agree to Mark regarding that. I think at the end, the user experience will win. And me, as a, a developer or producer of product or of security tokens, what I care, of course, there's the most ways of distribution channels, that there are the many distribution channels for both primary and secondary markets of as many as possible, and that they're as easy as possible. We could compare to Bitcoin. There are maybe thousands of exchanges and places you can go and exchange Bitcoin via cash and back, but still majority of people may be using 5 worldwide because of the user experience, because they are good, they are legit, they are regulated, and etc. So that's the same. I do believe there will be large secondary security token exchanges, like regulated, centralized with license, and then there will be big players, real estate developers, maybe come together with the banks or something, I don't know, to provide the liquidity pools, and they will just do their in-house. They will simply be a big brand, trusted by people. They can trust that, and I hope in a front-scene future we'll have a real estate.exchange will be one of the major players in Europe of doing it, because they are in the right path. They probably just need a little bit of tech and just nice liquidity providers, and then it's done. That's what I would like to see, that there's simply nice, easy, convenient secondary market for security token buyers, as it is right now for utility token buyers. If we go even close to that, functionality, right now, of course, it's getting regulated because it was technically so easy, but legally there was almost nothing. They ignored every single rules there were to just make it super easy. If we get half close to that, it's a very great success already.
Thank you, Kristaps. And yeah, that's the bottom line. It's making a product that people will love to use and that provides real benefits. So any closing comments from anybody on this? Otherwise, we'll end it here. Thank you so much to all of you, to the speakers, the panelists, and to those of you that have joined us for this great discussion. Yeah, see you for the next DigiShares webinar.